There. Welcome everybody to the special meeting of Lacombe City Council for Monday, April 29th. It is 5:30 p.m. I will call the meeting to order. As you will see, no consent agenda, relatively few items, all of which are financially related this evening on the agenda. You've had an opportunity to review it. CEO Gowdy.
Thank you, Mayor Creasy. Administration would recommend that council look at a slight alteration of the agenda order that's presented before you. That you would start with item 3.1, the presentation of the audited financial statements, then go in camera for your legal item, and then come back out for item 4.1, the financial report and audited financial statements. So you would be going 3.1, 6.1, then 4.1 before continuing with 4.2.
Really makes sense for this evening's purpose. Councillor Hoekstra.
Thanks, Mayor Creasy. I move that we accept the agenda as amended. Yeah, the ordering amended. Yeah.
Thank you for that clarification. Appreciate that. Anyone else? Very good. Please go ahead and vote. Just got a small technical issue here. Councillor Ross does not appear on the voting list there, so we'll and as if by magic, it is fixed and the votes are in. Exciting stuff. That is unanimously in favor. Thanks, everyone. So here this evening, we've got two representatives from BDO Canada, the partner, Mr. Alan Lidster, thanks for coming, and Mitchell Kennedy, the senior manager here today, and a little bit of an unusual situation we find ourselves in this end, close to the end of the month in a special meeting, perhaps for those watching online and wondering, just a brief synopsis of why we are here for a special meeting, please. And then the floors will be yours for the presentation.
Awesome. Are we going? Yeah. So today we are presenting the audited financial statements for the city of Lacombe. That's the main purpose of our presentation today. We're going to go through the statements and Mitch is going to kind of do a high level look at the financial statements. But essentially, if there's any questions, jump right in. Certainly answer as we go. So.
Okay, I appreciate that. I guess it just can be confusing for some people watching at home that we are having a separate meeting for this. I'm not trying to throw you or BDO under the bus here.
Oh, as far as timing goes, you mean?
There was some timing issues this year.
Yeah, there certainly were. This year there was quite a few different moving parts in regards to things like standard changes of that nature. So therefore we had to push back the meeting till 1 week till today. So that's why we're having that special meeting today as far as the statements go. So
thank you. Appreciate that. Please proceed with your, seeing no questions, please proceed with your presentation.
Passed. Everybody can hear me? Okay. So I'm going to start off with the independent auditor's report here. If I can figure out how this device works. Sorry, I can't get it to... Sorry for this, guys.
Not unlike the voting machines, we have a hierarchy of technical control here. And wait.
Okay, that works.
Thanks, Mr. Tomnick.
Okay. So we have audited the consolidated financial statements here in front of you today. We conduct our audit in accordance to Canadian generally accepted auditing standards. Management is responsible for the preparation and fair presentation of these financial statements here in front of you. Our objective as auditors is to obtain reasonable assurance that these consolidated financial statements in front of you are free from material misstatement. We're issuing a clean audit opinion on these financial statements. It's the same opinion that we give you guys every year. Before I get into the statement of financial position, I just want to talk about two major changes in the public sector accounting standard world this year. And that's going to be the adoption of standard 3450, which is financial instruments, and then the adoption of section 3280, which is your asset retirement obligation. I'll go through those in a little bit more detail later. Financial instrument one isn't really too different than how the municipality has been treated in the past. It's just more contextual information for the reader to outline the same risks that have always been there for municipality, just allowing the reader to get more information. I'll talk about ARO more once I get to the actual notes. But starting with the statement of financial position here, what I like to do is I like to do a high-level comparative from the current year to the prior year. Any significant differences between the two columns, I'll discuss what's creating those changes. But you'll also note on the 2022 column, there's a restated value. That restated is there because of the asset retirement obligation standard. It's because of the modified retro approach that's being used. It's not saying that there's an error in last year. It's just saying it's a restatement due to the introduction of PS 3280, which is ARO. And there's a big note that will kind of change what the restated values were based off of how they were issued last year and what was causing those fluctuations. But this is a normal restatement for this specific standard. Yeah, so to talk a little bit about the standard asset retirement obligation, it's just has to do with your entire TCA listing as a municipality. And so you have to effectively do a deep dive into what you have as a potential liability for when that specific TCA becomes retired. So that could mean a number of different things. In the situation of this municipality, there were 4 things that were kind of identified in the asset retirement obligation state. That was asbestos related to your buildings, retirements of lagoons, pump houses, and your hockey arena, which had pneumonia that is going to need to be assisted with in order to safely retire that chemical. So it's basically whenever your TCA requires any kind of additional retirement obligations, this is what that standard is kind of addressing. And it's to help municipalities show from a capital budgeting perspective what kind of future potential cash outlays might fall within the municipality in the near future. Is there any questions on that standard? Okay. So just going down, you can see your cash is up about $6.5 million. That's mostly due to about $3 million in new debt that was issued in the year, as well as collection of grants from the previous year. So you'll see that your accounts receivable is down from the 7.6 million to your 4.9 this year. Going further down to your liabilities, there's your deferred revenue. Your deferred revenue is down quite a bit. Your remaining deferred revenue is made up of grants related to MSI, community building, and grants related to Highway 2A. And then there's other amounts in there as well. Then just right under that, you're going to have your asset retirement obligation. That's a new line item this year. That's to talk about your liability related to Section 3280. This liability is going to fluctuate based off of economic conditions or doing an accreted expense to it. So it will change every year. So next year, if you see the numbers different, it's not necessarily because you've incurred a new liability. It's just the truing up of the value. So last year you can see we call it discounting it. When you discount it back, the original value was recorded at 399,000. The difference of the 418 is called an accretion adjustment to effectively true up the liability to what today's value of that would be. It's kind of a complicated calculation, but it takes into consideration borrowing rates, inflation, useful life of the retirement of the TCA. But that's effectively what that liability is coming to.
So what's happening with municipalities in the world, what they're trying to get to is a full accrual system. So over the last years, I mean, like sick leave liability, things of that nature. So what they're trying to do is take a picture and a snapshot of everything you have, look out into the future, what expenses or what things you have to basically accrue on your balance sheet as liabilities in this case. So this ARO is a future look at an asset that you're going to retire 10, 20 years from now and bringing it back to the balance sheet now, right? Saying in our current year dollars, this is what it looks like, right? And so that's why you're going to get changes in that estimate based on those factors of bringing it back and inflation and cost of living and all those type of things. So it is going to change according to all those factors, but it's a forward look saying, okay, you're going to retire this asset. What's it going to cost us right now? And then you accrete it or make that change as you go. Does that make sense?
So I guess from yes and no, while I appreciate the whole idea of planning for the future and whatnot, is really the net result of this to have higher reserves for certain assets, and I'm assuming.
Yeah, that's a great way to put it as well, right? So essentially, you're looking at ways to fund those future potential liabilities. Yes.
Right. And given that this has been a fair bit of grief for
Everyone.
accountants, especially, I'm just wondering the overall value of it, to be perfectly honest with you, given that a lot of facilities and those assets are in the future, substantially in many cases, could be half a century or more with some. I'm just wondering how much liability rests with the current users for the retirement of that item when it is so far out in the future, if the work going in actually justifies itself for that end result.
Right. So it really goes back to what you just said before, is that looking at reserves, getting an indication of what that future liability is and talking about it now, so to speak, right? So that's, in our mind, that's if you're trying to pin a value to it, short of, in our world, it's a standard that has to be met, obviously. But that's that whole forward looking thing, that forward planning thing. So in your guys' case, the liability is not as big because your infrastructure is maybe newer, you don't have some of those issues, right? Whereas other municipalities will have more issues in regards to some of these aging infrastructures that they're going to have to plan for, down the road. Those liabilities could be higher.
Right. And just to offer some clarity, you said a standard that has to be met. Just to be clear, this was not a government imposed obligation. This was
There's a CPA.
a CPA,
Yeah.
was it not?
Yeah. Well, I mean, it's the government has to follow those standards essentially, but it was an imposed standard for sure. So.
Okay. No, I just wanted the public to understand that.
Absolutely.
Okay. Thank you.
Okay.
Sorry, just if I could, just because if they move on, it'll. But there is no obligation to fund said liability. Correct.
No obligation. No, not that we're aware of. Yes.
So much like tangible capital assets and depreciating the asset, it helps plan, it raises the idea to decision makers like counselors, but there is no obligation to fund depreciation or retirement of an asset. And I should also say it's retirement of specific named assets that have some sort of remediation, like obligated remediation. It's not, we have this building and we're going to stop using it and it's going to cost us $50,000 to tear it down. It would be, it's going to cost us an additional $20,000 because there's asbestos in that building. When we do tear it down, it's going to cost us $70,000 instead of $50,000. And so you're accounting for that $20,000 that's to do with a legally obligated remediation, not just the cost of decommissioning something.
Right. Yeah. Great way to put it.
Okay. Then there's just your long-term debt. So you incurred you received about $3.3 million in proceeds from your long-term debt, and you paid down a principal portion of about 1.2, 1.3. And there's your TCA, which is just going to be a mixture of your acquisitions in the year of about $12 million. Then there's your disposals and then your amortization for the year, which is going to make that change up. So then your ending accumulated surplus is moving from the 183 million to the 194 million. And so your financial asset position increased from the $1 million last year to the $4.2 million this year.
Councillor Ross.
Excuse me, thank you, Mayor Creasy, but I feel you're moving forward in your packets, but not on the screen, and
I'm still on this page. Oh yeah, I was just finishing that.
Moving ahead. Sorry, my apologies.
No.
Thank you.
So next slide is a statement of operations. So I do a similar look from a comparative standpoint, but I'll usually start with the budget to see what was approximately budgeted for in the year and see if there's any variances between what was budgeted to what actually happened. And if there's any differences, then I'll compare it to 2022 to see if there's any historical reference to that number. So just looking at your total revenue, you'd budgeted 39 million in operating revenue. Your actual revenue is 45 million. And so a good chunk of where that's coming from is related to your contributed assets. So your contributed assets are capital assets that you received in the year. They were given to you. And so those gifted items are going to be made up of roadways, water, wastewater systems, storm sewer systems. And those are going to be located all over City of Lacombe. And so your other change is going to be your other revenue, which is going to be made up of things like other contributions or amounts for joint economic development as well. And that's effectively your sales and user fees are up approximately about $1.5 million from what was budgeted and 1 million from last year. So that's related specifically to your water and your wastewater amounts. And so that's causing your change from your budget to actual. And then on your expense side, you guys budgeted pretty bang on from what actually happened in the year. You budgeted about 41.5 million in total expenses. Your expenses were a little bit higher, but your revenues were as well. So there's your excess or shortfall before capital items of $3 million. And then there's your other amounts, which is your government transfers for capital. So your government transfers for capital, that's just your capital grant revenue. So you had recognized about $7.2 million in capital grant revenue in the year, which leaves you with an ending excess of revenue over expenditures of about 10.2 million. And that just shows your fluctuation between your beginning accumulated surplus to your ending accumulated surplus. Okay. I'll quickly talk about the statement of change in net financial assets and debt. This is similar to like a cash flow statement. It just shows you the changes from where your surplus or deficit from operations starts from. And then it takes into consideration your change in so you purchased $12 million in capital assets. On those capital assets that you own in aggregate, you had about 7.5 million in amortization. And then you had proceeds of $180,000. And then there was some write downs of about 35,000. And then there's your change in prepaid expenses of about 71,000. That's just looking at your current year to prior year change. And then there's your consumption of inventory for about 36.5. And then there's your accretion expense or your change in your ARO liability for your 19.5. And I'll just quickly run you through your statement of cash flow. Your starting point is the previous page, which is going to be your surplus of $10.2 million for the year. Then we add back the non-cash items that are made up in your surplus value. So in your surplus, you're going to have contributed assets, which is the non-cash item that we have to put in there. Then there's your amortization, which is a non-cash item. And then there's your accounts receivable. So any change in non-cash operating balances, those are just literal changes from your statement of financial position from current year to prior year. So if your accounts receivable goes up to $2.7 million, it means that you received $2.7 million, or sorry, your change in AR from last year to current year is down 2.7 million. So that's what's causing that change. And then accounts payable goes the other way. So you have a change in 560,000. And then you have your acquisition of TCA. So even though you had the $12 million in capital asset additions, you actually only paid $10 million in capital asset additions because the remaining amount was 2.4 in contributed assets. And then there's your proceed from the issuance of debt of about 3.4 million, and then the repayment of long-term debt of about 1 million. And so your total net change in cash for the year is the 6.4, which explains your change from your beginning to your ending balance. So there's been a couple additions to your significant accounting policies. I've already talked about this at the beginning. I won't bore you too much with these, but I will just highlight that your financial instrument significant accounting policy is here. This isn't anything new for the municipality. It's just a required disclosure as part of 3450. And then going a couple more pages forward. There is your significant accounting policy for your asset retirement obligation. I don't want to beat that one up anymore unless you guys have any more questions about it, but it just explains what an asset retirement obligation is and how it's accounted for and treated. So then there's this note. So this illustrates why there's that restated column using the modified approach. So you'll see on the far left column, the 2022 as reported. These were the numbers that were issued in your 2022 financial statements. Because of asset retirement obligation this year, there's restated values. So the new values for the restated columns are going to be on the right, and it just shows you that you're effectively setting up a capital asset, you're setting up a liability, and you're having accretion adjustments that effectively run through your income statement. So there's that change there. Then talk about your cash note. So, sorry, my pages are getting sticky. So your cash note, you had about $9 million in cash. So of that $9 million in cash that you have, approximately 3.8 million of that is restricted for use. That 3.8 million is just tied directly to your deferred revenue. It means that your revenue is currently deferred for future projects and expenditures. And so your difference in cash that is not currently restricted is that 9 million minus that 3.8 million. And of your current cash balance, the city has an undrawn line of credit for $2.5 million, which is not currently used, but it's there if you need to use it. This note number
Just
7
one moment,
here.
please. Councillor Hoekstra.
Thanks, Mayor Creasy.
Yeah.
So back to that line of credit, that 2.5 million, that is not in that number though of 9.
Correct.
Oh, it is, or it's not? No,
Sorry, the 2.5 is not in that
not
number
in
at all.
that number. It's just that it's there. waiting
Yeah,
in the
just
wing.
to show the reader that if the municipality needed to use a line of credit, it is available, but it's not in that balance. And the deferred revenue note. So this is just literally emphasizing what your restricted cash is. It's just your MSI, Canada Community Building Fund, Northern or Regional Economic Development, Highway 2A, and then there's your other deferred amounts, which consists of prepaid business license, recreational funding, and land use funding. So then there's your long-term debt. So your total long-term debt that you currently have is about $22.7 million at the end of the year. Every year for the next 5 years, you're going to have a total of $1.9 million in payments. This is going to be made up of your interest and principal portions. Once you get after 2028, it doesn't mean that you're going to have a lump sum payment that you have to make. It just means that our continuity schedule just cuts off after the 5 years. So you'll see it kind of reduce every year going forward. So your change in accumulated surplus. So your accumulated surplus is effectively the equity of the municipality. It's the net book value of a municipality, and it's effectively broken up into 3 different parts. The biggest piece is your equity in TCA. So that's just taking your total net book value of your capital assets, and it subtracts off your debt related to your total TCA, and it comes up with a value of $166 million. And then there's your reserves and your unrestricted reserves. So your current reserves that you have set aside is $15.6 million. That $15.6 million is broken up into all of these reserves on the previous page. So you have your general capital reserve, general government reserves. All of those reserves are what breaks out that 15.6 million that you currently have there. And then there's your unrestricted surplus. So your unrestricted surplus is the equity that you currently have that is set aside for whatever council and management decide to do with their unrestricted amounts. They can move it to reserves. They could leave it the way it is. It's up to you guys to decide, but that's currently what your unrestricted amounts are. Then there's the expense by object note. I like this note because it's just a different presentation of what your expenses are for the year. It just breaks it out by your salaries and wages, your material amounts. So it's not on the statement of operations, it's broken out by function. Where here it's illustrated by a different presentation. Just to give reader more context of what the actual expenses incurred in the year for the actual municipality. Then there's the debt limit calculations. So the total debt limits, those are governed by the MGA. And so they're calculated using specific ratios set out within the MGA. And effectively all it does is it takes your total operating revenue for the year and it multiplies it by the indicators specified within the MGA. So it says you take 1.5 times your total operating revenue, and this gives you your total debt limit. And then there's your debt servicing limit, which is calculated similarly by using a multiplier of 0.25 against your total operating revenue. So what this is saying is your maximum debt as a municipality that you can take out is $64 million. You currently have $22.7 million in debt, which leaves you with a total debt limit of availability room for $41.2 million. And then there's your internal debt limit, which is set aside, that you guys have set aside. And you stipulate that the city of Lacombe has their own internal debt limit, where the city will not take on more than 0.75 times what is calculated under the Alberta regulation. So you guys had set aside an internal debt limit of 48 million, which leaves you with your total internal debt limit of available room of 25.2. Then your debt servicing limit is the amount of debt that you can service in a year, which is going to be a combination of both your principal and interest payments that you can make in a year. So the maximum threshold that you have is 10.6 million. You're currently servicing about 1.9 million a year, which leaves you room with 8.7 million in debt that you can service in the year. So these are set out by the MGA. If you ever want to surpass these debt limits for whatever reason, you need to get a municipal approval in order to do so.
Are you aware of any of the debt that we have that is affected by that servicing limit that are shorter term or more volatile, or are they all lengthy obligations?
Your current loan with the Alberta Finance Authority. Just one sec here. Yeah. So I'll just take you way back to. So right here. So maturity, it matures between 2025 to 2051 is the latest portion of your long-term debt that will expire. So it will get less and less as you pay off the specific chunks related to the Alberta Loan Authority. I don't have that exact breakdown in front of me, but you have different loans within the Alberta Finance Authority that will mature over different periods of time.
Right. I guess the reason I was asking is because of municipality and the agreements with the financial authority. Those are longer term fixed rate agreements. They're not subject to market volatility and whatnot like many loans are.
Yeah. So then there's your budget note here. So you had budgeted surplus from operations of about 7.3 million. And what this budget note is doing is it's effectively reconciling from what you guys had budgeted in the year to your total surplus amount. And so your 2023 budget amount is to show that you did actually balance a budgeted balance. Sorry, that sounded redundant. Yeah, you had a balanced budget, and this is showing how the budget was balanced. Because when your statement of operations, it's going to show that you didn't have a budgeted balanced budget. Sorry, I don't know why that's so hard for me right now. So your statement of operations is going to say that you have a $7.3 million budget, but there's going to be things in there related to amortization, acquisition of TCA, debt payments, and transfers that aren't going to show up on your statement of operations, but this is just to show that your budget is actually balanced in the year. And that's my spiel. I don't know if you guys have any other questions that you'd like to ask. We'll show you this new note. This is the 3450. I'm not going to go through it, but it's the financial instrument note, which is extremely lengthy. Like I said, this isn't anything that the municipality wasn't already facing before. It's just illustration or context for the reader to explain financial instruments related to the municipality. So.
Thank you. CAO Gowdy.
Yeah, thank you. One of the challenges I've had with some of the non-cash items that show up on the financial statements is it does sometimes make it difficult for the reader to get a real feeling for what has occurred. Could you go back to page 4 for me? And
Page 4?
yes. Okay, so this one, for example, I look at this as a layman and I say, wow, that's pretty good. The municipality budgeted to lose 22 million in the year, but actually they made 4. That's quite a swing. But that's not real, right?
No.
So help me understand as just a lay person, was it a good year or was it a bad year? And when I look at that, I think, well, did reserves go up? Yeah, they went up 4 million. Did you have a surplus? Yeah, you had a $900,000 surplus. But that's just me saying that.
Right.
What do you think?
So similarly to what you were saying, I usually use 2 main indicators. I look at your unrestricted reserves and your reserves to see what the movement is, but I actually look at like your financial asset position as well, where it compares, okay, your liquidity and your assets and your liabilities. If you take those 2 values and you net them together, how did that balance move in tangent with last year? Is it in a better situation or is it in a worse situation? So if you look at your financial assets last year, you had $34 million in financial assets, but you had $35 million in liabilities, which says that you have a net financial debt last year of $1 million. But this year, your position significantly improved, which is showing that you have more readily available funds. So it's a good year for the municipality overall. And you do have that increase to your reserves as well. So ultimately, it was a good year for the municipality, to reiterate.
Continue.
Okay, I have a less self-serving question for this one. Why does the current statements not include a threshold of materiality? And as a subsequent question, I'm assuming that materiality this year will be higher than the adjustments that were made to the 2022 statements due to ARO. So why go through the exercise of restating 2022 statements if materiality isn't actually affected?
So that's an interesting question. So I'm laughing for a couple of different reasons. So under the standard 3280, you have 3 different approaches for how you can account for it. There's the prospective approach, where you literally can just ignore prior years and treat it as a current year going forward thing. Then there's the modified retro approach, which means you go back in time, you restate prior year. And then there's the complete retro approach where you go all the way back in time to figure out what that liability would be. So Municipal Affairs had published a document that a lot of municipalities interpreted that they had to use the modified retro approach. We later found out that Municipal Affairs wasn't dictating a specific way to go about this, and people didn't find out about this until 3 or 4 months ago. And so everybody theoretically could have used the prospective approach, but Municipal Affairs implied that they recommend municipalities use the modified retro approach, which created the restated numbers for last year. So it was just to be compliant with the standard. Theoretically, there was an argument where we could have said the amount was not material in nature and put it in our unadjusted entries, but we decided to show compliance to the standard and basically reflect that you were restating just to follow 3280. So,
And one thing to keep in mind is a lot of the work is to figure out that this is the liability, right? Whether you set it up or not. So that's really the other part to this is, yes, you have to still go through the exercise and do those things. And then like Mitch is talking about, we're kind of going to what the municipality or the MGA is saying, you should set it up this way. So theoretically, yes, you're right, it's under materiality, but you got to keep in mind all the work up to that point, just to figure out that that is the number essentially is there, right?
Well, and not unlike that, following the figure of the position of the municipality as a whole, these will have more value as time goes on. So there's something to compare them to and see some sort of a trend. If in fact that retirement of a liability is falling or rising as compared to your overall financial picture. Is that fair to say?
Yeah, I agree with that as well. And another thing is comparability across other municipalities and things of that nature as well, right? So it just goes to show where everybody's at in regards to this, because the standard should be applied the same across the board, right? But I agree with you. Yes, as time goes on, it kind of trues it up, I guess, right? So.
Were there any other questions or comments from council or administration for that matter? From the auditing perspective, was there anything additional that you would add at this time?
I think we covered everything. Yeah.
Very good. Councillor Hoekstra.
Thanks, Mercusi. Since we went back to page 3, I guess this is a question for administration, maybe. How did we budget for rental revenue at 298 and it actually came out to 965? Like what is, please explain that.
So it's just the nature of how things are categorized. So rental revenue is where the Vesta Energy partnership money shows up. And so that's almost entirely that unbudgeted amount.
Councillor Ross.
Thank you, Mayor Creasy. Now that Council Hoekstra brought up the Vesta Energy and rental agreement, if those lagoons, that lease agreement ceases because of oil activity in the area halting, are we obligated under Alberta Environment to reclaim the lagoons, which what could be $2, $3, $4 million? Should we be putting money into reserves for that reclamation? And I'm anticipating that Vesta says that we could be in the $1 million for 2024 because of the increase in activity and so forth. So if that, or should we be putting money into reserves for reclamation?
I certainly hope those kind of projections are accurate. However, it's kind of hard to count on them until they become reality as far as administration is concerned, but we can certainly keep our fingers crossed. CEO Gowdy.
The obligation actually from Alberta Environment is to have a plan adopted for reclamation. You don't have to actually do reclamation, and so the city has satisfied that requirement. We partnered with Colliers Project International 4 or 5 years ago and created a plan that met the requirements of Alberta Environment and Parks. But certainly we hopeful that they'll be an asset to the city for many years before they become a liability.
Very good. Not seeing any other lights on, so well, it's certainly an option that we receive the presentation. It's not a requirement. However, seeing none, we will continue on and move into our in-camera portion, item 6.1. And before we do that, Councillor Hibbs.
Sorry, not before that. I was just going to make the motion that we move in camera.
Wonderful. 6:11 by my clock. Very good. We are back online. Councillor Dallas?
Thank you, Mayor Creasy. Motion to come out of camera.
And it is 6:30 PM. Other lights on, please go ahead and vote. I think quite often do that when we're still in camera. I'm kind of messing up. There, you can go ahead and vote now, please. Sorry about that curveball there, Mr. Dominic. And that is unanimously in favor. Thank you. And that takes us down to request for decision, category number 4. Senior Manager McKinnon. First off is the financial report for the fourth quarter financials and the audited financial statements and surplus allocations. Item 4.1, please.
Thank you, Mayor Creasy, and good evening. Tonight, I'm here to present the 2023 variance report for the City of Lacombe and seek your approval for the 2023 financial statements. Contained within this report are the City of Lacombe's 2023 audited financial statements, presenting a comprehensive snapshot of our financial status as of December 31st, 2023. The 2023 audited financial statements reflect an unqualified opinion from the independent auditors, showing no concerns that would give any rise to potential issues. The close of 2023 marked an overall operating surplus of $880,642 for our city. Note 19 of the draft financial statements on page 24 show the operating surplus that is comparable to our budget. In Q4 of 2023, we experienced notable variances between our actual revenue expenditures compared to budget. Total revenue surpassed expectations by $3.5 million, with major variances outlined in our revenue summary. Conversely, expenditures exceeded our budget by $2.6 million, primarily because of significant variances detailed in the expense summary. For a more detailed breakdown, Appendix A provides a comprehensive overview of our Q4 2023 actual versus budget by fund category, while Appendix B delves into the specifics of object line variances. And Appendix C shows the operating surplus by each department. Our operating surplus of $880,000 in 2023 is largely attributed to the Lagoon Water Storage Agreement and the high interest revenue return. We propose transferring the surplus to the General Capital Reserve. This decision aligns with our annual budget and taxation preparation policy and the financial reserve policy to strengthen our financial foundation and minimize future borrowing for capital projects. The capital surplus of $3.9 million results just from a timing difference in borrowing $4 million for the Public Works facility in 2023, where the expenditures will occur in 2024. Tonight, administration recommends your approval of these statements. MGA Section 278 requires each municipality to submit its financial return and audit statements to the minister by May 1st of the year following the year they are prepared for. In closing, I assure you that administration will prepare a comprehensive reserve report before the 2025 budget, ensuring transparency and adherence to the financial reserve policy. Thank you for your attention, and I invite any questions or discussions.
Thank you, Senior Manager McKinnon. Councillor Ross.
Thank you, Mayor Creasy. With the favorable interest revenue and having presentations from our investments and so forth, anticipation of interest rates going down, under the MGA, can we invest our reserves longer, and then when interest rates projected come down, could we then use our operating? So we thus keep our interest investment revenues higher for until the interest rates do come down.
CEO Gotti.
So we do invest in blocks that have staggered, what's the word I'm looking for? Maturity
Due
dates. And the bond market does do a similar forecasting as what you're talking about, where they actually price in sort of what they see likely to happen with interest rates. So yes, I would say the short answer is yes, we do that. The longer answer is it's not as the market's already try to calculate that, and so it's not as favorable as you might think to lock rates in for longer periods of time, because when you do so, they've also looked at it and said, well, probably interest rates will drop over that time, so we'll give you a lower rate than if you're paying for 2 years or 6 months. And so there is some balancing there. You also need to balance your cash flow. So Senior Manager McKinnon does some forecasting of when large payments will be due from projects like the Public Works building and what our cash flow needs will be, and then looks for times where we might be going into the red. And of course, we try to balance that to make sure we are using our operating reserve whenever that happens and not dipping into the line of credit.
Senior Manager McKinnon, so just wanted to verify that because of the motion that was made on April 24th, it was for $845,000 be transferred to the general capital reserve. And then today we are proposing an $880,000. How do those two numbers relate to one another?
What was the first number again? I'm sorry. From when?
$845,000 that was resolved to have been transferred on the April 24th meeting. That was to go to the general operating, or the general capital reserve.
Mhm. Was that in a, I'm sorry, was that in a council report or was it a April 24th?
At our meeting.
Okay. The,
Basically, is that separate funds or is that inclusive of the 880
that is
today?
the whole amount of the surplus 880,000 is to go to the general capital reserve.
Correct. And on April 24th, thank you very much. And I just looked at the wrong date.
Oh, I understand. Now.
For the-
You're looking
for-
at last
for the year.
year's
I'm
number.
thinking, so are we increasing this by 35,000 or I was gonna say, I didn't see $1.5 million increase on the reserve, so thank you.
Thank you for helping me out.
Councillor Dallas. I just noticed the year up front, so appreciate that. Yeah, exactly. Councillor Hibbs.
Thank you, Mayor Creasy. I would just go ahead and make the motion that council approve the 2023 audited financial statements as presented.
Thank you. And I'm not seeing any additional input, so call the question. Go ahead and vote, please. A sigh of relief as we receive a unanimous favorable decision there. Thank you. Councillor Hibbs.
Thank you, Mayor Creasy. I'd just like to say that I do agree with the recommendation here to do with the transfer. I think that while there are other options that we could do with that surplus, I think in the idea of sustainability and that the future benefits outweigh anything immediate, I move that council directs administration to transfer $880,642 to the general capital reserve.
Thank you. Any additional comments or concerns with that motion? Very good. Please go ahead and vote. And that is unanimously in favor and therefore passed as well. Thanks, everyone. Senior Manager McKinnon, you're on such a roll here. Item 4.2 is yours as well for the 2024 tax rate bylaw proposed for first and possibly second reading. Thanks once again to our auditors. We appreciate you coming in on late notice. Better late than never. Right. Yeah.
Good evening, Mayor Creasy and Council again. This evening, I'm here to present the annual property tax bylaw 516 and the paving tax bylaw 517 for 2024 for consideration of first and second readings. The City of Lacombe provides essential core services that are available 24 hours, 7 days a week, including policing, fire, emergency management, roads, and utilities. The city also provides community value programs and services for parks, recreation, and culture. The services provided impact the quality of life for Lacombe citizens. The cost of these services is funded through taxes, utility rates, and fees and charges. Municipal taxes support vital services and programs. They protect residents with emergency services like fire and police, enable transportation across the city via roads and sidewalks, promote health and wellness through recreation facilities like arenas and pools, enhance community beauty within parks, green spaces, and public art, enrich quality of life through cultural events and activities, support local economies by attracting businesses to the area, manage growth through land use planning and project oversight, ensure transparency through clear communicating and reporting, maintain financial sustainability via long-term planning, plan for the future with strategic initiatives, capital plans, and budgets, foster sustainability through green initiatives to reduce greenhouse gases, and protect community assets with effective asset management and infrastructure maintenance. The 2024 operating budget was approved by Council on November 14th, 2023. The municipal operations include core services, value-added services, asset maintenance, special projects, reserve transfers, and debt servicing. The operations are 100% funded by different funding sources such as property taxes, reserves, grants, user rates, development levies, and other sources. This picture shows the process of arriving at the tax rate bylaw. The first column shows the city's budget process, August to November, typically. The process identifies total revenues required to deliver services. We then subtract other sources of revenue, including government grants. Then we subtract fees, rates, and charges, and that gives us the tax requirement. The second column shows the assessment process. It occurs between December and April. Total revenue required in column 1 is used to calculate the amount of taxes payable on each property. Third column is the tax rate bylaws. Tonight, administration is requesting council approve the first and second reading of property tax bylaw 516 and paving tax bylaw 517, so we can prepare and send out tax notices in May. Council approved a budget that included 3.75% tax increase in order to fund services provided by the City of Lacombe. This slide shows the impact to the taxpayer who owns a residential property valued at $350,000. They will pay municipal taxes of $2,995 per year, or $249.59 per month. The municipal taxes are used to cover the cost of municipal services. The municipal services provided include everything in the middle box, which includes snow removal, fire and emergency, transit, playgrounds, noise control, ball diamonds, safe roads, libraries, community events, policing, animal control, path and trails, hockey rinks, counseling services, grass cutting, swimming pools, and pest and weed control. What would $250 per month get you in other areas of your life? Maybe monthly cable and internet, fancy dinner for 4, maybe a power bill, weekly groceries, monthly insurance, or possibly a family phone plan in comparison. Bylaw 517 relates to the paving tax that is budgeted at 1% of municipal taxes from the 2023 requisitions. The revenue funded paving improvements within the city of Lacombe from this bylaw. The $172,000 to be collected from this tax will go directly to offset partial costs of pavement rehabilitation of C&E Trail, 500 meters north of 72 Avenue to the city limit. The slideshow shows the impact of the taxpayer who owns a residential property valued at $350,000. The annual impact of the paving tax is $25.11 a year, or $2.09 per month. What could you buy for $2.09? In comparison, maybe a coffee, box of pasta, pop, bottle of water, candy bar, or possibly a loaf of bread. Property taxes are one of many taxes citizens have to pay. The municipal revenue toolbox includes property taxes, fees and charges, and utility rates. The federal and provincial revenue toolbox includes income tax, consumer taxes, gaming revenue, oil and gas revenues, and tariffs. The municipal revenue toolbox is small in comparison to the provincial and federal government toolboxes. Tonight, administration is requesting the council approves the first and second reading of the 2024 municipal tax bylaw 516 and the paving tax bylaw 517, along with the budget changes presented in table 4. If there's any questions, I'm happy to take them now.
Thank you, Senior Manager McKinnon. Appreciate that. Start with Councillor Gullickson.
Thank you, Mayor Creasy. I'll make the motion that council gives first reading to bylaw 516.
Councillor Hibbs.
Thank you, Mayor Creasy. I just wanted to comment that I obviously really like this presentation. We've all said that before, but I did want to make an additional comment on that very last slide about property taxes and the competition with other levels of government. Of course, we are very limited in our ability to generate revenue. And I'd also just like to point out that some of our revenue, of course, comes from transfers from other levels of government, and we've seen reductions in that. So that also then therefore puts further pressure on municipalities. And again, given the very few tools that we have in our toolbox, that's a very difficult thing for us to balance at this table. So I just thought that that was just really worth highlighting for the public, that it's all well and good when you hear other levels of government giving themselves pats on the back, but quite frankly, that actually comes at the expense of this level of government. So I just wish to make that point.
Thank you. Doesn't appear to be any additional comments. So with respect to first reading of bylaw 516, put forward by Councillor Gullickson, please go ahead and vote. And that is passed unanimously. Thank you. Councillor Dallas.
Thank you, Mayor Casey. I guess, so we're on to the next one here, but I'm just curious if, and I apologize because every time I read this, I cannot make it make sense in my head. And I'm sure this is year 2 of this. So in the residential section, it says if a home assessment remains unchanged at $350,000, there will be a decrease in the 2024 requisition. And that is just what our collection is, not what we want as our requisition. Am I correct in that?
CEO Gotti?
We had a good discussion about this. It's common for municipalities across Alberta and beyond to use that metric of a house of X value. What it ignores, and we had kind of arrived to, like, it kind of paints a fake picture, because yes, as property values go up, your mill rate goes down to compensate, because you want to collect the same amount plus 3.75 in this case. But so if the property values go up by more than you raised taxes, then the mill rate actually going down or goes down. And so all things being equal, a house worth $350 last year that's also worth $350 this year will actually pay slightly lower taxes, because they are having a lower mill rate. All residential is getting a lower mill rate. But it's a fake situation, because if I owned a house of $350,000 value last year, I know it's not $350,000 this year. It's $350,000 plus 5% or something. And so really, it would be very unlikely that my property value remained exactly the same. And so since my property value increased by 5% plus the 3.75% increase, that more than offsets the mill rate, and thus I actually pay $8 a month more or something. And so that's more reflective of the true experience that Lacombe residents will have, is they will actually pay $5 to $10 a month more per household in tax in 2024 than they did in 2023. Despite the mill rate going down, everyone's property values have gone up. And so when it's applied to that, there is an actual out-of-pocket increase to that cost.
So likewise with that same thing, we have a few residents each year who phone up, generally not in a particularly favorable mood, suggesting that their taxes went up, pick a number, 10% or 12% or whatever. And generally speaking, that's because they've had a substantial increase in the overall value of their property. If you would care to elaborate further on that, CEO Gotti.
Yes, or there's a change in the status of the property. So you and I had actually talked with a gentleman who was seeing about a 10% increase. But once we looked into it, we said, well, actually there was an infrastructure change on your street that increased the value in the properties on that block. And thus, when sales occurred on that block, which is what the assessor uses to value the homes, he realized, oh, that infrastructure change has resulted in higher prices being sought and gotten for these homes. Similarly, if someone's seeing 12% increase, often once we look back and say, well, how's it been over the last 5 years? And there will be a couple of years where they actually decreased, and then maybe went up 4, and then up 2, and then up 10. And so that if you take it over a period of time, it actually is a very gentle tax rate increase. They do vary year to year based on home sales in the neighborhood of similarly sized and priced and characteristics homes.
And once again, something important for residents to realize that each and every property is not evaluated by our assessors each and every year. That's just an unrealistic expectation. So when they're lumped together by area or even by block, that there can be some adjustments, but over the longer period of time, they do work out accurately.
Yes, and that is actually tested every year. The province applies, I call an accuracy test, to the assessor's model. So they say, based on your assessment model, these 100 homes that sold last year in Macomb ought to have fetched $50 million. And here we have actual sales values for those 100 homes, and it equals $49.8 million. And it has to be within 3%, plus or minus, for the assessor to receive provincial accreditation to continue his assessment in future years. So there is a little idiosyncrasy where they kind of always undervalue it. It's never 102%. It's always 98% because it's easier to justify a slightly lower price. But they are tested. The audit quality is tested every year. Sorry, the assessment quality is tested through a provincial audit. And typically, our auditor actually achieves a higher standard of being within 1% of the model and the true sales values of homes.
Thank you. Councillor Gullickson.
Thank you, Mayor Creasy. Now, our 3.75% increase makes up that 700,000 difference is in the amounts from the previous year. It's about 700,000 more tax this year than last year we're collecting.
So it would be a combination of the 3.75% plus any newly developed properties.
Correct. Okay.
That it also includes other revenues. If you look at the different, like you're looking at.
Great taxes.
Oh, state, yeah, okay.
Yeah, it's about $700,000. I just have a problem with the 3.75%. I know it's probably the wrong time to bring this up, but the consumer price index right now for Alberta is about 3.5%, and that includes food costs. And I don't think the city has a lot of food costs in their cost adjustments. So I think our rate should be around 3%, which is about the correct amount if you took food out of the adjustment, because it's about 3/4 of a point, I think. So I have a real problem with that. I don't know if we can change that now. We did vote on that in November. So, but I do have an issue with the 3.75.
C.A. O'Gotti.
So I'm not sure about the 0.75 for food. I haven't seen any data that shows that's directly responsible. What we have seen before is a concept that you're talking about called municipal price index. And so it attempts to more accurately reflect the basket of consumer goods that reflect municipal spending than consumer spending. And so you're correct. Municipality does not buy food. It does buy a lot more construction than the typical home consumer would buy. And so actually things like fuel, asphalt, electricity is a big cost. And so it always drives higher than the consumer price index. So I've never seen a municipal price index that would be lower because the construction industry typically sees higher escalating prices than other industries do. And that is a big part of what municipalities spend their money on. To though, it would require significant additional work, but it's certainly, if it is council's wish to revisit the tax rate, you do see that other municipalities are doing that. Edmonton, for example, when they came into their spring adjustments here, changed their tax rate increase from 6.2 to 8.7% to more accurately reflect inflation, and they are a municipality that uses municipal price index to justify those increases.
Councillor Dallas, were you removed off the queue intentionally, or did you have something? Okay, very good. Councillor Ross.
Thank you, Mayor Creasy. For future budget deliberations, I'd be curious to know how far less our tax dollars going for getting previous comparable construction done based on only all due respect, a 3.7% increase, because I bet you our construction cost to do our projects has went up considerably higher than what CPI is. And how much are we getting behind on what we necessarily should be doing to keep up with our, the depletion of some areas versus our tax increase because of the cost of construction since, unfortunately, COVID has went up significantly higher than CPI itself, as have the costs of many other things.
Director Thompson.
So I would say that the council is supporting the things that help to manage that issue. Asset management planning drives those decisions for municipality, and so for things like the road network, while it is difficult to do that kind of assessment every year, we do plan to do a reassessment of our road network and to bring forward another report that can compare to what did we plan to do and how much it would cost versus what do we actually do and how much did we actually spend. Then we can determine at that point, moving forward, does that level of investment make sense? Do we need to adjust it for the next, say, planning cycle? So it's kind of a thing that we would probably do on a less frequent basis than annually, but certainly it's something that we're working into the regular operation with the City of Lacombe with our asset management planning moving forward.
If I may follow up.
Certainly.
I guess it would be interesting to know 5 years ago, cost per meter of water sewer pavement replacement versus today. Because I think that would be an alarming number that we're probably not honestly facing compared to what should be consistently due to replace over X amount of years.
I don't think there'd be too many that would argue that it went down. However, there's some, there's an awful lot of factors that goes into that. I don't know that how easy that number would be to come up with, but I think you're 100% correct that it is definitely substantially more. Councillor Gullickson.
Thank you, Mayor Creasy. So are we going to use that municipal price index in the future as a guideline instead of CPI?
We have never brought it forward because it is some effort to calculate. And I think that it is publicly hard. It's a hard sell because it looks like the municipality has cherry picked this indicator that allows them to pass a tax increase higher than inflation, right? Rather than saying, the inflation that we're all feeling as residents of this city equally kind of thing, consumer price index, we're going to calculate this other number that, yeah, there might be a rational basis for it, but that really results in justifying why we should raise taxes even more than CPI. And I just don't think it's a very persuasive argument. I don't think a lot of people in Edmonton, for example, are saying, well, 8.7, that's okay. That makes sense. They're facing, the city's facing pavement costs. It's a lot more to put pipes in the ground today than it was 5 years ago. Give them a break. I think people look at that and say, well, they found a way to rationalize what they wanted to do. And yes, certainly, I'm happy to bring that number to future budget deliberations based on what Edmonton is facing. Often their municipal price index is probably very relatable to what you would see here in Lacombe.
Yeah, well, I think that's the point Council Ross was bringing forward. Like if we're not keeping up, that's important. But it is hard times for our citizens right now, and I don't know. I just 3.75 to me seems high, but I understand the rationale behind it, and it is something that I'd like to see us. I don't know how we get the right numbers, but this municipal price index seems to be really high, and would be very frightening to our citizens to see those kinds of numbers. if that is what Edmonton is using at 8.7, you said, is that right? Or 8.17? They were lower than that, but they increased it recently, correct? And was that because of that municipal price index, do you know, or just a shortfall in their revenues?
I don't know for sure. I'm taking a
Of
look.
course, that's Edmonton, not us. We don't really care that much, right? So, I mean, I still have a problem with 3.75, so but that's in my own head. But thank you for the information.
So I think important to that discussion is the fact that council does spend a great deal of time and has an awful lot of input onto where the dollars that our citizens do provide through taxation to operate the city go, and provides those services and amenities that hopefully mean the most to them, because quite honestly, we don't have enough resources to meet all of the demands that are put before us. I think that we happen to do a pretty admirable job with the funds that we do get. And regardless of what that final number is, I think that in this particular case, as we have in the past, it's justifiable. Saying that, I think everyone would like it to be lower. Reality comes into play, and I think that we've come up with a reasonable balance, in my opinion, but that's certainly something for council as a whole to decide. Councillor Hibbs.
Thank you, Mayor Creasy. I believe there's no motions on the floor currently.
Correct.
So I would go ahead that council approve the budget changes in table 4 in this memo.
Thank you. Any related discussion on that topic? I don't believe so. Please go ahead and vote. And that item is passed unanimously for the budget changes in table 4. I think there was a hope that we consider additional readings. Councillor Ross.
Thank you, Mayor Creasy. I also move that council gives second reading to bylaw 516. Oh, second.
No, you're right. That's correct. Thank you.
Am I correct?
Yes. So for second reading then proposed for bylaw 516, any additional input? Please go ahead and vote. And that item is passed by a margin of 6 to 1. Councillor Gullickson, so noted. Councillor Hoekstra.
Thanks, Mayor Creasy. I would like to move that council give first reading to bylaw 517.
Thank you, commonly known as our paving tax bylaw. Any input on this item? Please vote. First reading is unanimously passed. Councillor Dallas.
Thank you, Mayor Creasy. Motion that council gives second reading to bylaw 517.
Thank you. Now that item is before us. Just curious if anyone else has had public input on that very specific tax. Once again, I don't think you're going to hear anybody jump up and down wahoo another tax. However, my experience has been that a significant majority of people like the idea of where that money is going and are slowly seeing the positive results. Councillor Hoekstra.
Thanks, Mayor Creasy. Yeah, I wasn't going to, haven't had citizens saying specifically about the tax, but people are noticing the state of our streets and that they are improving, and they just appreciate how Lacombe looks.
Councillor Gullickson.
Thank you, Mayor Creasy. I've only heard positive about this, which is really a bit of a shock, but people do like to see where that money is going, and I think it's a good process for us to work with.
Councillor Koenig.
Thank you, Mayor Creasy. I just had one individual who said that our roads were terrible, and I told him to go take a drive in Edmonton. So no, I think this is good, and like you say, it's been overwhelmingly positive. People like to see smooth roads for sure.
I guess I do have to temper some of those inputs, and I think that we have perhaps not done a terrific job in letting the public know that there's a reason behind not completing the finished lift of asphalt on construction areas, because that has probably been the only negative input is on some of the capital works programs from last year. Happy to see it done. Maybe not quite so happy to see them not completed. However, I'll give Director Thompson another opportunity to explain the theory behind holding off on completing that final lift of pavement in some of those areas in the city that people are probably most annoyed with.
Sure, yeah, happy with the opportunity. So we really want to make sure that the public's dollar that is going towards road rehabilitation is ensuring that that road has its maximum life. And so when we defer the top lift of pavement, we're doing so because there is usually because we've done some deep utility replacement in that road, which means we've dug fairly deep, and there is a chance that there will be some soil consolidation, some settlement in the road, and that by deferring the top lift of pavement, it allows us to, I guess, deal with that, along with any other deficiencies or issues that might arise over a freeze-thaw cycle. If we have to dig up the road again to address a problem, for example, that may have occurred over the winter, we can do so and then apply the nice finished product, the nice finished top lift of asphalt on the road, without having to cut into it and introduce joints and things that slightly shorten the life of the road. And obviously, it gives us a chance to have a nice grade, nice cross section, nice drainage on the road as we intend. So it makes the road last longer and drain as it should.
Appreciate that, Director Thompson. If we keep repeating the reasons behind why it does go that way, perhaps the word will get out that there is thoughts behind it, and some of the negative input with respect to our chosen contractors or the city organization as a whole will slow a bit. I don't know that we really have any more motions before us. Okay, possibility of second reading if we're so inclined. Well, it was made. Thank you, Councillor Dallas. I'm sorry. I had forgotten you did make that motion for second reading for the paving tax. One last opportunity for input. Please go ahead and vote then. And that's lit up green. That's unanimously in favor as well. Thanks, everyone. We do have some next meetings up here. The end of our agenda. All our regular council meetings here at City Hall at 5:30 PM. And they are on May 13th, May 27th, and June 10th. You can feel free to add those to your calendars. I believe that concludes our business for this evening. Councilor Hoekstra.
I'd like to move that we adjourn.
Thank you. So before we do adjourn, I want to thank council for yet another meeting. Important nonetheless, but I know I do valuable everybody else's time as well as staff, and approving these numbers in our overall financial health is important. So thanks for taking the time on yet another Monday meeting. And as far as adjournment goes, I don't think we're gonna have much dissension there, so go ahead and vote on that one too, please. That is unanimously in favor as well. We are adjourned.